Hello, I'm Kyle Rodder and welcome to this week's Investor Spotlight. In this week's episode, we take a look at the Australian retail landscape and discuss 3 consumer stocks to watch. Australia's retail sector has proven remarkably resilient. Owing to a historically tight labour market, ample household savings and high levels of household wealth, consumption in Australia has remained strong. This is despite stubborn cost of living pressures and the RBA's aggressive campaign of interest rate hikes, which has sapped consumer sentiment in the past 12 months. Retail sales in Australia has been strong in recent months, even accounting for the effects of price growth on the data and seasonality. And according to the most recent set of national accounts released by the ABS, although consumer spending moderated in the fourth quarter of 2022, it remains significantly above trend. Here are 3 consumer stocks to keep an eye on. In the most recent reporting period, Domino's results were amongst the most disappointing. Its shares dropped by more than 20% on the day it reported, as the company flagged persistent cost pressures, weaker demand as households curb spending, and lower margins as consumers opt to pick up their pizzas rather than have them delivered. The analyst community is forecasting a 12.59% drop in earnings for the company in the 2023 financial year, with Domino's holding a consensus hold rating amongst brokers. The stock does boast a consensus price target above the current market price at around $62 per share. The technicals look poor for Domino's shares currently, with the stock nearing its pandemic lows. While going to pains to emphasise the growth the company's experienced since the beginning of the pandemic, Harvey Norman missed earnings estimates and flagged further discounting on expectations of weaker economic conditions. Analysts are forecasting negative revenue and earnings growth for the foreseeable future for Harvey Norman, with brokers slapping a hold rating on the stock despite the share price trading at a slight discount to the consensus price target. Harvey Norman shares remain in a downtrend and remain slightly above 8-month lows. JB Hi-Fi's interim results revealed solid growth in revenues and profits, with the numbers coming in line with expectations. However, the business delivered cautious guidance and warned of future discounting as discretionary spending wanes in the Australian economy. Analysts expect a halving of earnings next half and negative EPS growth until 2025. The company possesses a hold rating amongst brokers. JB Hi-Fi shares look range-bound in the bigger picture. The stock is currently oscillating around its 200-week moving average, with drops below that level often bought by investors.